Welcome to Paladin Financial Talk. I am your co-host, Tony Shore, and I'm here with our host, Matt Bryant. Matt, great to see you today.
Tony, always good to see you.
Going to be a great show today, isn't it? You've got a huge guest. I don't even know how, this is a huge get for the show. Don't know how you landed it.
It's a big haul. So I had to pull some strings, but we got with us President of Gradient Life Brokerage, Jay Guerin.
Wow.
Hi, guys. How we doing today?
We're doing great.
I think you oversold the huge get a little bit, but I'm happy to be here.
All right. Well, hey, before we get started, though, Matt, in case our listeners have questions throughout the show, maybe they want to write it down before we get started or commit it to memory, how can our listeners get a hold of you if they have questions?
Yep. So you can always go to our website, paladinfinancial.com. There's a place on there to request a call from us or give us a call at 651-842-8406.
All right. Sounds good. And welcome, Jay. Wow. President of Gradient Life.
The brokerage. Gradient Life Insurance Brokerage. And I appreciate it. I appreciate being here. We're recording this on National Life Insurance Day. So recording this show on National Life Insurance Day. So I guess it's appropriate for me to be here.
Yep. Just kicks off a month-long life insurance focus for Paladin. So you get me today, and then you'll have the rest of the Paladin team for the rest of the month. And we'll go even deeper than today. It's just kind of high level on the different types. And then we'll go deeper and deeper as the month goes on.
That sounds great. I know a lot of people have misconceptions about life insurance and misunderstandings and how it can be utilized. There's a lot more to it than people realize. So, Matt, I will let you take it away with this amazing guest today.
That's right. So from a very high level, there's two main types. There's term life insurance, and then there's permanent life insurance. So I'll talk a little bit about the term, and then we'll switch over and spend quite a bit of time talking about permanent. So term life insurance is just what it sounds like. It lasts for a specified period of time. So most commonly you're looking at 10 years to 30 years. The idea is this is a low cost way for you to get life insurance to cover, if you're young, maybe you're covering while you raise a family, while you have a mortgage, that sort of thing. And then the idea is at a certain point down the road, you're more financially stable, things are paid off, kids are out of the house. So you don't really feel like you have the same need for the life insurance. So this might be you're starting out, you're not making as much money, you don't have that foundation built for your finances. So, God forbid if something happened, you died, and you've got small kids, you've got a mortgage, your spouse, maybe you're a 2-income household, you lose one income or your spouse doesn't work at all. Like, what do they do? So it's important to be, from a planning perspective, have that in place for those years as you're growing a family.
Yeah, for sure. Would you agree with that assessment?
Yeah, I think you hit the nail on the head. And it's funny, you gave a little pause when you said when you die, right? No one wants to talk about it. No. Your clients don't want to talk about it. They don't want to talk about end of life things. But if you haven't planned for those things, this is where the life insurance comes in. And especially term insurance, like you said, it's being able to help make those mortgage payments, income replacement, those types of things. And it's for a specified amount of time.
Yeah. And you're right. No one thinks they're going to die when they're 35 or 40. But imagine that happening when you have a young family or you have this debt. It's already a difficult enough time, and you're dying unexpectedly. And now your spouse, your kids have no idea where that money's coming from to keep going. So it's not fun to think about, but if you really want to bulletproof your financial plan, this is something you should have in place.
Yep. Right on.
The second type of insurance is permanent life insurance. There's all kinds of different varieties of permanent life insurance. This gets into more comprehensive financial planning. So it's not, hey, I need to bridge the gap for 10, 20, 30 years. I want to, obviously there's the death benefit with life insurance, but there's also some more financial planning concepts like building a cash reserve inside of it, tax planning, income stream, and retirement. So it goes beyond just, hey, cover me in case those emergencies happen.
Yeah, you're exactly right. So the term insurance, the main or the priority there is it's death insurance. Really, it is the death benefit, and that's really why you're buying it, is just for that death benefit. The permanent insurance, like you said, brings in more of a comprehensive side of the planning, where exactly what you're bringing up. There's a number of different things that you can look at and that you can use life insurance for, and permanent insurance is not just death insurance anymore. There's so many other things to it, not to mention on the tax planning side of things and on the income planning side of things, absolutely. But you also have living benefits on these policies, and living benefits are something that people, I mean, it's fairly foreign to people right now. They think life insurance, why would I get it? I'm never going to get to use this stuff. It's only for my kids or grandkids. The living benefits are for when you're living. Should you be tagged with a chronic illness or something, you become incapacitated, you can actually access that death benefit prior to passing away. So there are things where it can help with long-term care costs and things like that prior to death. And that's where the permanent insurance really comes in as well.
Yeah, that's huge. You mentioned long-term care, and I've had to deal with that with my parents right now. My mom has Parkinson's and is in long-term care. My dad still lives independently, but he has been now diagnosed with Parkinson's, so he's going to need it eventually. And the costs are crazy. My mom's care right now, the overall care is over $11,000 a month. Okay. And so how would you cover that?
Right.
And traditional long-term care insurance just isn't around anymore. And that's getting tougher and expensive. And the money that goes in, and you lose it if you don't use it, right?
Yep. And that's what Matt brought up with making your financial plan bulletproof. Is you have a lot of ideas of how you're going to spend your retirement nest egg that you've been building your entire life. All of a sudden sickness or illness comes into play and you have long-term care needs. Rather than spending down your entire legacy, like I said, you're able to access some of that death benefit ahead of time to pay for those long-term care needs. So you're paying pennies on the dollar compared to even dollar on the dollar if you're drawing it directly out of your retirement account. So
right.
Yeah. And if you think of, for a lot of folks, legacy is important, where you want to leave something for your kids or a church, whatever foundation. And say you get into a situation where you lived maybe longer than you're expecting, or your health isn't as good as you were hoping, and you didn't do the planning and you depleted your assets. Now there's nothing left. Well, this allows you to use your assets while you're alive as well, and then still have something left once you do pass away to fulfill your legacy wishes. So it adds a lot of flexibility to the plan.
And a great way to think about life insurance, a very simplistic way to think about it is it's appropriate for if you live too long, if you die too soon, or if you get sick along the way.
Seems like it covers everything.
It seems like it does cover everything.
That's pretty good. And especially the permanent life. Now you mentioned, and maybe we're getting to this, Matt, I don't want to jump ahead, but at some point I do have a question for Jay. You mentioned a cash I hear the term cash value policy. So with these permanent life insurance policies, not only can you utilize them while you're still alive, if you have something urgent come up, they can be set up to kick in to help with long-term care, or you can access the death benefit to help with that. But you mentioned as retirement income or cash value. What does that mean? How does that work?
Yeah. So with permanent insurance, you're still paying where there's the death benefit. So there's a cost of insurance on there, but you're also using it as a vehicle to grow money inside of it. And so you're able to use it. And we're going to talk indexed universal life, because that's one of the most heavily used forms of permanent insurance. But what you're able to do is you're able to put it in there, and it's going to grow as the indices that are attached to the policy, grow. And what you're able to do then is, as that cash value grows inside of there, you're able to take withdrawals or take loans against the policy, and those are income tax free. And so you hear a lot of people trying to avoid increasing their income taxes and decreasing the amount of taxes that they want to pay. Permanent life insurance is a phenomenal way to be able to do this, because you're putting in after tax dollars, and then as that money grows, the withdrawals come out income tax free. So it doesn't add to your earned income in a given year. It doesn't bump you up a tax bracket. So whether you're looking for some sort of monthly structured income out of this, they can be designed that way, or you're looking for something just to be able to take lump sums out of. I see that a lot. So we definitely do a lot of income planning where at age 60, I want to start drawing an income stream from this. But I also see it where people say, okay, well, I've got a college payment coming up, or I have a down payment on a house, or want to go on a vacation. Well, let's just say it's a $50,000 lump sum that you want to take out to put for a down payment on a house or on a vacation, a car, a boat, whatever it may be. If you take that out of your qualified accounts, you're effectively adding $50,000 of earned income to your tax bill. And so it may cost you $60,000 to get to that $50,000. Whereas you can just pull $50,000 out of this cash value life insurance and you're not increasing your tax bill at the same time.
Yeah, you get
Wow.
the benefit of solving the life insurance need, the death benefit, but then taxes are set to increase here in a couple of years if nothing happens. The way our government spends money, it's likely to increase over the next few decades regardless. So having this extra diversification as far as taxes go, that's a huge benefit. Not to mention, Jay, you talked about getting some growth inside the policy. There's no stock market exposure as far as decline. So you can get some participation to the upside, but this isn't a piece of your overall strategy that you don't have to worry about if the market's down 30%, losing a significant chunk of your assets.
That's correct. So how these index universal life policies work is exactly that. It's tracking against an index that's out there. And so you're participating in the gains and the growth on that index. But any years that index is down, you just have a zero return. So you don't participate in the down, you get to participate in the up. And it's a really nice conservative strategy for being able to grow some money in there. And again, along with the other benefits that should you die too soon or get sick along the way, you've got those living benefits or the death benefit there along with it.
And all of our current clients are familiar with how we go through our first appointment. And we talk about, everybody knows that as far as investments go, you should be diversified. You're not putting all your eggs in one basket, but we take it a step further and talk about diversifying your tax buckets as well, so that as your income changes, as life goes on, as tax policy changes, which you really have no control over, you have these different things inside your portfolio so that you're efficiently pulling money out. And this is one facet of that can certainly help.
Yeah, in my years of working with Paladin and knowing you folks, you guys do a great job of identifying the taxed now, the taxed later, or the taxed never buckets. And so diversifying your investments is one thing, but also diversifying that tax allotment is a huge strategy that you guys utilize.
Yep. And I'm going to back up a second. One thing that a lot of people bring up is permanent life insurance can be too expensive. So we talk about, as far as cost goes, term life is going to be the cheapest thing you can get, right? There's not a lot of benefits to it. You're not using it for retirement necessarily. It's just there in case you died. There is a higher cost with permanent life insurance, but that's because you get all these extra benefits to it, which more than offset what the potential cost would be. And I think that's one thing a lot of people struggle to overcome is, how can I actually visualize how these extra benefits help me 15, 20, 30 years down the road?
It's also more expensive because of the permanent nature of it too.
You're
right?
guaranteed to use it.
It's gonna get used. That death benefit is gonna come out of that policy in one way or another. And some of these are, based on the different policies, some of them are guaranteed to age 120. So you're not gonna outlive this thing. and so this death benefit's getting paid out. So as long as you look at it in terms of, okay, how much am I pouring into this thing versus how much is coming out, it's always a win as far as the amount that's going to come out. It's just a matter of if you're going to use it in your lifetime or if your kids / grandkids are going to use it.
Or both. You use some and then they get
absolutely.
some. Right?
Absolutely.
Yeah, it seems like a good way to, I used the word bulletproof earlier, but like not only bulletproof something for your heirs, but also you're in those years between 60, 65 and 90, 95. Like this is just one extra bucket where you can use for emergencies like chronic illness or just tax-free income.
And that's something that it also offers with permanent life insurance, is that flexibility.
Mm-hmm.
And so whether you had originally planned to create an income stream out of it, now you want to just use lump sum withdrawals, or hey, I'm not going to need that money, but let's hang on to it to make sure that long-term care needs are going to be taken care of if I have those, or obviously the death benefit side of it. The flexibility inside of these is huge.
Yeah.
And so the permanent offers that flexibility, whereas the term, again, it's you're renting that insurance. You're renting it for as long as that policy is good for. This one is more of a long term. I know that I'm going to keep putting money into this thing.
Yeah, and we haven't even talked about estate taxes and the impact that could have on your legacy. For a lot of folks, maybe it doesn't apply, but policy there changes every several years, it seems like. So having something in place, if you are especially higher net worth and you plan on having substantial assets that you pass, having this in place is a way for you to help cover some of those taxes that will come up.
So if I have a permanent policy and I pass and there's a death benefit for my wife and kids, do they have to pay tax on that money typically?
No, income tax, no. And so we always want to make sure that we identify what kind of tax we're talking about.
Sure.
But no, it is an income tax free vehicle,
right?
Which is also another really nice piece, because, for example, if you pass away in your 70s or 80s, oftentimes your kids may be in their highest income earning years.
Yeah.
And so to add on a bunch of taxable assets there, the Internal Revenue Service could be taking upwards of 40% of that in an income tax form.
Sure.
Life insurance, death benefits, life insurance proceeds are income tax free. And so you talked about the estate plan inside of it, Matt, and that's why life insurance is such a valuable tool and vehicle inside that estate planning process, because it provides for liquidity. And looking at the federal estate taxes, you said these things change all the time. You brought up earlier that these tax laws are going to change. They're set. If nothing else happens, if the government does nothing, then on which
seems likely.
They're really good at that. That's
I feel like both sides are getting along really well right now, and they'll probably come to an agreement, right?
Sure.
So if nothing happens, the Tax Cuts and Jobs Act of 2017 expires on December 31st, 2025. So we're a year and a half-ish away from that. And the tax rates are going to go back to what they were. So on the estate tax side of things, right now it's 13 million and change that's exempt from estate tax on the federal level. That's a pretty big number.
Big number. Yep.
On January 21st of 2026, that drops to $5 million. And they'll adjust it for inflation over those years, but 5 million is the base and then adjusted for inflation. That brings a lot more people into the conversation. Not only that, but state of Minnesota has their own estate tax. So the state estate tax in Minnesota, that exemption level is $3 million. And again, that's a big number, but people that are sitting there with $1.5–2 million right now as a 60-year-old, you've hopefully got 20 plus years of growth still happening. So start planning now for those tax needs. And that's where life insurance comes in to provide liquidity, because what's really hard to do is if I owe $500,000 in taxes when my mom passes away and I don't have that kind of money, it's really hard to sell half of a cabin that I inherit.
Yeah. And just like I said earlier, it's a stressful time anyway. And now it's a complete nightmare trying to coordinate with siblings. Hopefully everybody gets along, but we know that's not the case. You're talking about families getting not torn apart, but significant strife happening. And our governments are good at spending money, and we spend a lot of money that we don't have. So whether it's income tax policy or estate thresholds, it's not out of the realm of possibility that those could stay low or become lower in the future.
Well, and that's what, we always talk about, and people are familiar with interest rate risk and market risk and tax risk. Well, legislative risk is a real thing.
Yeah.
And so if Roth IRA rules are changed, if contributions to your qualified accounts are changed, you want to make sure that you're in some sort of vehicle that's grandfathered into that, which is again why life insurance is a nice vehicle for this tax planning purpose.
And going back to the beginning of the show, the rest of the Paladin team is going to be diving deeper on these various types of life insurance and also really laying out how to use them to benefit your overall plan. So today, high level on the two main types, the importance of having it inside of your plan. If you are concerned or unsure if you need it, obviously talk to us at Paladin. We're here to help and something we navigate every day.
All right. Well, guys, great show today. One more time before we go, Matt, let our listeners know how they can get a hold of you if they have questions about this or other financial topics.
Okay. PaladinFinancial.com. Tons of great resources on there. You can request a call from us as well, or just give us a call, 651-842-8406.
All right. And Jay Guerin, thank you so much.
Hey, I appreciate you
Thank you,
guys
Jay.
having me. Willing to do it anytime. So thanks for having me. Good luck with the next month of content that you guys have coming up. I'm sure it'll be useful for your listeners.
Yeah,
Appreciate
for
it.
sure. All right. That does it for today's episode of Paladin Financial Talk.